Bloomberg, Federal Reserve officials raised interest rates for a third time this year and reaffirmed their outlook for further gradual hikes well into 2019, risking fresh criticism from President Donald Trump. The quarter-point increase boosted the benchmark federal funds rate to a target range of 2% to 2.25%. The move reflected an upbeat assessment of the economy that was identical to the central bank's last policy statement 8 weeks ago, despite concerns over Trump's escalating trade war. Growth and job gains have been strong, and inflation remains near the central bank's 2% target, the Federal Open Market Committee said in its statement Wednesday following a two-day meeting in Washington. Barring a negative surprise in the economy, updated dot plot forecasts made a December rate hike almost certain, as the number of FOMC officials expecting another increase by year-end grew to a bigger majority of 12 for made in the previous round of projections in June. In the statement's only change from the previous one issued August 1, the committee dropped its long-standing description of monetary policy as accommodative. That's an acknowledgement rates have moved closer to the neutral level, which neither boosts nor restrains the economy. The tweak in language led investors to sell the dollar and buy treasuries on the assumption it meant the Fed would be less aggressive in the future. The Bloomberg Dollar Spot Index fell as much as 0.3% to a session low, and the yield on 10-year treasuries dropped to as low as 3.061% from around 3.08% before the decision. Fed Chairman Jerome Powell and his colleagues are trying to pull off a feat the central bank has accomplished only once in its 104-year history: engineer a soft landing of the economy by raising rates just enough to prevent overheating, but not so much that they trigger a recession.